Withholding tax often targets government revenue beyond domestic sources to include portions of income that fall within respective jurisdictions. Kenya plans to increase withholding tax on dividends to 15% and the same tax on short-term government bonds to 25%. In a similar move, Uganda, through the income tax amendment, bound to be passed before the upcoming financial year, has targeted gross payment for asset acquisition, with the exception of sellers who had their property as trading stock. Meanwhile, concern remains that the final tax may not reflect the true value of the capital asset at disposal. Still, taxes are bound to be perceived by investors as extra expense, thus a deficit on potential profits. Beyond that, there is worry of unviable investment in certain circumstances.
You'll find that some of these companies and investors will run away. That acts as a deterrent. So for them, they will always try to run away because of that. The other issue that investors will look at is the investment climate in terms of, for instance, waivers, incentives which are available. How quick can you register your business? How quick can you be handled? And the level of corruption in the country. If a country can be able to give an investor what they want within a short time without giving them hard time, then investors will be able to flow in. But indeed, we want to agree, and I want to agree that yes, if you are going to slap big taxes, for instance, 15% on dividends, nobody would love to pay tax. You know people, even from the days of Jesus Christ, it was seriously known that people hate to pay taxes. And that is why somebody had to make a comment those days. One of the kings, I'm told, said, give to Caesar what belongs to Caesar. And that statement holds water. People need to pay taxes, but people don't want to pay taxes.
Inputs, when you tax labor, when you tax, eventually the same investor gets tired and they can think of other places to invest. So we have to be careful about how much we are taxing same companies or same investors.
Tax professionals consider capital gains as a two-way street that could generate revenue for government, but also impact investors or taxpayers' capacity to provide support to the less fortunate. While it is crucial for government to gather sufficient investment to enhance service delivery, lawmakers contend this move must be meticulously scrutinized.
So capital gains tax, first of all, as a country, Uganda, our capital gains tax regime is one of the highest, whereby if you're a company, you pay 30% capital gains tax on the capital gain, whereas if you're an individual, you can pay as high as 40% on the capital gain. That's quite high.
When they go to the markets, they buy so many things. Most of those things already have VAT in them. They have taxes in them. Nearly whatever you touch in the market has a component of tax in it. Nobody should tell you that it's tax-free. There is a cost. Even if it was a tax-exempt product, as long as the person is through a vehicle, that vehicle went through taxes. So to a certain extent, indirectly, we contribute to tax. And therefore, yes, for me, first of all, I want to agree that when we raise the capital gains tax a lot, it leads to a flight in the investment. So people take off.
If passed for the upcoming financial year, there is extra ground to explore the outplay of the robust set of tax amendments, including stamp duty, value-added tax, and excise duty, among other financial-related revisions. Runana Habwe, Smart 24 TV, Business Today.